If you want to know whether your cash is safe, the first question is not which bank you like. It is not which bank has the nicer app. It is not which bank has the bigger name. It is not even which bank has the better interest rate. The first question is simpler, colder, and much more important. What structure is standing between you and your money? Most people never ask that question until the week they should have asked it years earlier. That is how bank failures ruin ordinary people. Not because those people were reckless, not because they were foolish. Usually they were responsible. Usually they were cautious. Usually they did what respectable people are told to do. They picked a bank that looked normal, kept their savings there, paid their bills on time, and assumed safety came from familiarity. Then the structure cracked, and when the structure cracks, the logo on the front of the building does not matter very much. I learned a long time ago that money is never just about the asset. It is about the chain of promises wrapped around the asset. That chain matters more than the marketing. A great many investors think they hold cash. What they really hold is a claim. That distinction sounds small until the day it becomes your whole life. Cash in a bank account feels like cash because the number appears every morning exactly where you left it. That is comforting. Comfort is one of the most expensive illusions in finance. The number in the account is not the same thing as bills in your hand, and it is not the same thing as a direct claim on the United States government. It is a liability of an intermediary. That is the sentence most people skip over because it sounds technical. It is not technical. It is the whole game. Your deposit is your asset and your bank. S liability, if the institution standing between you and that liability freezes, fails, gets merged, gets resolved, or simply stops functioning for long enough. Your relationship to cash changes immediately. It changes precisely when you least want surprises. That is why I want to talk to you about 1929. Not in the sentimental way people talk about 1929. Not as a museum story, as a structural lesson. When people remember the banking collapse of the early 1930s, they usually remember one number. Thousands of American banks failed. That number is large enough to frighten people and vague enough to teach them almost nothing. What interests me is not how frightening it sounds. What interests me is who survived it with their savings intact and why. That is where the useful lesson lives. Because there were people who lost almost nothing, not because they were prophets, not because they were members of some private club, not because they had private jets and senators on speed dial. They survived because they understood structure better than their neighbors did. That is the hidden line running through all of financial history. The people who come through intact are often not the people with the best opinions. They are the people whose structure does not depend on the weakest part of the system. That is what happened then. Most depositors in those years thought the risk question was about choosing a good bank from among many banks. That was too shallow. The real question was whether you were using the right kind of institution at all. A commercial bank and a depositor, first savings institution may both sit on a street corner and take your money, but they are not the same machine. They do not answer to the same incentives. They do not carry the same appetites. They do not fail the same way. In the early 1930s, that difference became the difference between sleep and ruin. The first thing I want you to understand is what I call the brand illusion. People trust names. They trust marble floors. They trust polished counters. They trust old signage and serious looking men in suits. They trust the familiar. The market has always known this. That is why surface trust is so easy to sell. But bank safety has never really come from the name painted on the wall. It comes from the behavior the legal structure allows and encourages underneath the wall. That is why some institutions held up far better than others during the Depression. Mutual savings banks, depositor. First structures, institutions without the same profit, chasing shareholder pressures, conservative investment behavior, lower appetite for the sort of speculation that looked intelligent right up until it detonated. They were not magical. They were shaped differently. And because they were shaped differently, they broke differently. That matters as much now as it did then. When I look at modern cash management, the first mistake I see is that people still think in brands. They say they have moved to a good bank. That may help at the margin. It is not enough. A serious person thinks in layers of institutional design. He asks whether he is concentrated inside one insurance regime, One regulatory framework, one operational channel, one payment rail, one point of failure. If the answer is yes, he is not protected. He is merely comfortable. Comfort and protection are cousins who do not always get along. The second thing I want you to understand is what I call the intermediary problem. Anytime your money sits inside a private institution, you are not simply holding cash. You are relying on the institution, the regulator, the insurer, the operating systems, the payment rails, and the legal process that would sort things out if something goes wrong. Now, I do not say that to scare you into absurdity. I say it because clarity matters. You cannot build a durable cash architecture if you do not know what it depends on. In normal times, dependence hides. In stress, dependence announces itself. That is why the people who survived the bank failures best did not merely diversify among commercial banks. The smarter ones moved some money into structures that behave differently, different rules, different balance sheet incentives, different legal backing, different rescue pathways. That is the beginning of resilience, not one safe place, multiple independent layers. That is how I think about almost everything in capital allocation, not perfection, redundancy. You do not build a house with one beam and call it safety. You build in load, bearing separation so that one fracture does not become total collapse. Cash should be treated the same way. This is where history becomes more interesting, because America once built a direct answer to the intermediary problem and then quietly erased it from the ordinary financial imagination. That answer was simple and radical. Let people place savings directly with the government through the postal system. No commercial bank in the middle. No need to wonder whether a specific bank had overreached. No need to guess whether some executive had chased the wrong loans. No need to optimize for yield. The promise sat directly on the sovereign. That is what made the old postal savings system so powerful during the Depression. It was not a brilliant return machine. It was a structural refuge. People poured money into it not because they suddenly became more sophisticated than before, but because the pain around them taught them a lesson fast. If you can step outside the failing architecture, you no longer need to argue about which broken room inside the architecture is least broken. That is the lesson I want you to think about, how important that distinction is. Most panic during financial stress is really panic inside the wrong frame. People start asking which bank is safest. That may be a worthwhile question after you have asked the deeper one. Can I remove a portion of my money from the banking system entirely and still keep it liquid, legal, simple, and directly backed by the government? That is a much stronger question. In the 1930s, one answer was postal savings. Today, the rough functional descendant is Treasury Direct. I am not saying it is identical in every practical detail. I am saying the principle is the same. You are no longer trying to choose the least worrying intermediary. You are moving a portion of cash outside the intermediary layer altogether. That matters. A great many people think safety is about insurance. Sometimes it is. But the best structure is often the one that requires less insurance in the first place because there is less intermediation risk to insure against. If you own a short Treasury bill directly through the Treasury, you are not asking whether a private bank can meet its obligations to you in the same way. You are holding a claim directly on the federal government. Either the United States honors that claim or it does not. That is the whole chain. I like simple chains. The longer the chain, the more I suspect the hidden weakness sits somewhere in the middle where no one is looking. This is why I keep coming back to architecture. Most people obsess over rate. They will risk structure to pick up a little extra yield. That is exactly backward. Cash is not supposed to be the flashy part of your life. Cash is supposed to be the dependable part. Cash is the bridge between panic and opportunity. If your bridge depends on too many fragile supports, you may discover you have yield and no access at exactly the wrong moment. That is not clever. That is a very expensive misunderstanding. Let me say something else that most people do not like hearing. The purpose of safe cash is not maximum return. The purpose of safe cash is continuity. Continuity means the bills get paid. Continuity means the mortgage clears, the groceries are bought, the payroll is met, the family does not lose its mind because some institution somewhere froze, merged, halted, or temporarily limited access while the lawyers and regulators sort out language nobody reads until disaster forces them to continuity, is underrated because people are spoiled by the smoothness of normal times. Then one disruption comes along and suddenly continuity is priceless. That is why I do not think about cash only as a passive holding. I think about cash as a system, and every serious system needs more than one wall. The first wall is ordinary operating cash in a mainstream institution, but kept inside clear insured limits, not because I despise banks, because I prefer discipline to romance. If you need a commercial bank for daily life, use it. Use it as a utility, not as a shrine. A utility is something you use for function, not something you worship for safety. That means you do not confuse convenience with fortress quality. The second wall is a structurally different institution, a credit union, a depositor, first framework, an insurance regime that is not the same pool as the first. Why do I like that? Because separate systems are better than duplicated promises inside one system. This is another place where people go wrong. They think spreading money across different logos inside the same architecture is the same as diversification. Sometimes it is not. Sometimes you have simply spread your trust across several doors that all open into the same burning hallway. That is not diversification, that is decoration. A truly different institution type matters more. Different oversight, different funding logic, different behavior under stress, different failure path. That creates true redundancy. The third wall is direct sovereign exposure through short-term government paper held with the government itself. This is where the old depression lesson becomes modern again. If part of your cash can sit entirely outside private banking intermediation while remaining liquid and rolling through very short maturities, you have built structural separation into your life. Structural separation is a beautiful phrase. It means one crisis cannot touch everything at once. It means one systemic shock has to work harder to find you. That is what intelligent architecture does. It makes the crisis less efficient. I like making crises inefficient. The fourth wall is the one people laugh at until they need it. Physical cash in small bills. Not because I think civilization ends next Thursday. Not because I have romantic fantasies about mattresses full of money. Because transaction continuity matters. If the payment rails stutter, if systems freeze, if local disruptions occur, if the digital layer becomes unreliable, for even a short period, small bills matter far more than people think. The crucial words are small bills. This sounds trivial until you understand the operational truth of stress. During a real payment disruption, a $100 bill is not always as useful as people imagine. A small denomination bill can move through ordinary life more easily. The principle is not heroism. It is friction reduction. You are not trying to become a bunker philosopher. You are trying to keep your household moving normally for a short window if the electronic layer stops behaving. That is rational. That is boring. That is exactly why it works. The more I study history, the more I notice that ordinary continuity beats dramatic gestures. People talk about gold when they are nervous. Gold has its place. That is a different conversation. But the old 1929 lesson is not really a story about gold. It is a story about keeping cash alive across changing structures, different problem, different tool. Now, I want to address the mistake sophisticated amateurs make. They hear all this and decide safety means they must find the one perfect institution. That is the wrong instinct. The one perfect institution is a fairy tale for people who do not understand systems. Systems fail in clusters, in layers, in sequences, through operations, law, psychology, contagion, and sheer confusion. Your answer to that is not perfection. It is layering. That is why I think of cash defense like a fortress with separate gates. If one gate jams, the fortress still functions. If one watchtower goes dark, the other towers remain. If one road closes, supply still arrives by another road. That is not paranoia, that is engineering. And the people who seem excessively calm during financial disruptions are often not calmer by temperament. They are calmer by design. Their structure is better. Structure is what creates emotional composure. That is one of the most valuable lessons in all of investing. People think courage produces good decisions. Sometimes it does. More often, good structure produces the appearance of courage. The man with one fragile bank account and no cash outside the system must be brave or desperate. The man with 4 layers of continuity does not need bravery. He needs only patience. That is much more reliable. If you want to know why the old postal model was quietly buried, I think the answer is almost too obvious to need dramatizing. A system that allows ordinary people to step partly outside the commercial banking model is inconvenient for the banking industry. Banks prefer deposits inside banks. That preference is rational from their point of view. But you and I are not required to think from the point of view of an industry. We are required to think from the point of view of our own survival and flexibility. That is what adults do with money. They stop asking what the industry wants them to think and start asking what the structure actually does under stress. That is the real dividing line between consumers of finance and stewards of capital. A consumer of finance shops products. A steward studies architecture. That is why I care so much about the legal and structural level. The legal structure tells you whose side the machine was built to serve when the music stops. The structure tells you whether your cash is a utility deposit, a member-owned claim, a sovereign obligation, or a stack of physical notes bridging a temporary operational gap. Each one behaves differently. That difference becomes your world during a crisis. Most people do not think in those terms because nothing around them forces them to, until suddenly something does. Then they wish they had built the architecture in calm weather. That is how every preparedness lesson works. You build the roof before the storm. You do not stand in the living room once the rain is already pouring through and begin reading the instruction manual. I know there is a temptation to say this is all too cautious, too technical. Too much effort for something that may never happen in a dramatic form. That is the wrong way to think about it. You do not build this structure because you are certain of a bank holiday, a cyber event, a regional panic, or a national freeze. You build it because the cost of sensible redundancy is low and the value of having it when it matters is enormous. Insurance always feels unnecessary right before it becomes indispensable. This is no different. And it has another benefit people miss. When your cash structure is right, your investment behavior improves. Why? Because panic leaks less easily into the rest of your portfolio. The investor who knows his cash continuity is secure is much less likely to liquidate long term holdings for the wrong reasons. He knows his household is covered. He knows his bills are not one institutional hiccup away from becoming a crisis. He knows he has time. Time is what bad structures steal first. A bad cash structure converts inconvenience into urgency. Urgency then infects everything else. You sell good assets because the wrong cash bucket failed you. That is exactly the kind of chain reaction I want to prevent. Which brings me to what I think is the most important sentence in this whole discussion. The purpose of a cash fortress is not fear. It is freedom from forced decisions. That is what you are really buying. Not an ideology. Not a prediction. Freedom from being cornered. I have always believed the worst financial choices are made by people who run out of time before they run out of intelligence. They know what they should do. They simply no longer have the structure to do it. That is why cash architecture matters so much more than people realize. It is invisible until it is the only thing that matters. Now, let me give you the way I would actually think about it if I were building from scratch. I would begin with the daily life account, enough for ordinary activity. Not bloated with lazy excess just because inertia is comfortable. Then I would establish a second institution of a different kind, not just a second logo. Then I would move a serious reserve into direct short-term government obligations held outside the private bank layer entirely. Then I would keep an offline transaction bridge in small physical notes sufficient for a short period of ordinary life. And I would stop there long enough to ask whether I had actually built continuity or merely rearranged convenience. That pause matters, because once you start thinking architecturally, you start spotting false safety everywhere. A large balance in one familiar account no longer looks comforting. It looks concentrated. A second bank under the same basic assumptions no longer looks like true diversification. It looks like a polite copy. The direct treasury layer starts to look far more useful than the average person imagines because it removes a category of dependence. Not just a category of fees, and the physical layer stops looking primitive and starts looking like what it is, a short-term transaction backup. Each layer answers a different risk. That is what makes the structure strong. This is also why I do not frame the question as, where should I store all my cash if banks fail? All your cash is the wrong phrase. The right phrase is, how should I layer cash so no single institutional change can paralyze me? That is the adult version of the problem. Adults layer. Children pick favorites. The more I think about the old 1929 lesson, the more I admire its humility. The people who survived best were not trying to be heroes. They were not proving a macro thesis. They were not performing intelligence. They simply stepped outside the weakest part of the machine and spread their dependence across stronger structures. That is all. Financial resilience is often more modest than people want it to be. No fireworks, no genius. Just the correct architecture, built before the crowd realizes architecture matters. That is why I wanted to tell this story in the first place, because I think a lot of people are carrying around the wrong mental model of safety. They think safety is emotional familiarity. It is not. They think safety is the biggest logo. It is not. They think safety is a reassuring insurance number repeated on television without any real thought about institution-type legal chain. Operational access or direct versus indirect claims, that is not enough either. Safety is structure. If you remember only one thing from me, remember that safety is structure. And the question that should sit with you tonight is not whether your money looks fine in the app. It is whether the structure holding it would still deserve your trust if the rules changed faster than the headlines could explain them. That is the question history asks every generation in one form or another. The people who answer it early sleep differently from the people who answer it late. I know which side of that divide I would rather live on. I would rather hold my cash inside a fortress than inside an assumption. Assumptions are cheap, fortresses take thought, but thought in the end is much cheaper than panic,